So in this video, I'm going to tell you why billionaires and investors are actually terrified, and it has nothing to do with the stock market. It actually has to do with the bond market. Now, unless you've been hiding under a rock, you'll know that the bond market is actually broken right now. Now, I'm going to get into a little bit more what that means and how you could potentially take advantage of this opportunity for the long term. But if you take a look at the U.S. aggregate bond total return value, this is the worst sell-off that we've ever had. We're also going to dive into the S&P 500, and I'm going to tell you what I'm seeing here as this head and shoulders did confirm, and now we are retracing back up to this neckline. However, as of the time of this recording, the bond market is closed, so the stock market is having a little bit of time to play. But let's first start with this bond sell-off. This bond sell-off is the worst sell-off in history if we're looking at the aggregate bond total return value. This is the aggregate of all investment grade bonds, not just corporate bonds and not just government bonds, but the combined value of all investment grade bonds. Now remember that the bond market is way bigger than the stock market. And why is this happening? Well, let's listen to Bill Gross talk about the reasons why this is happening, and I'll get into it.
What I think has happened, Katie, in the past several weeks, and the market is beginning to recognize Treasury supply, based upon a $2 trillion deficit. They're beginning to recognize, basically the selling of bonds by the Fed in terms of the QT. They're beginning to recognize higher for longer as well. And so
So he basically stated three reasons there. But one, there's an overflow of treasuries because the Fed actually started QT. Now, I tweeted about this. And by the way, follow me on Twitter and Instagram if you want free trading daily finance content. I post almost every single day on both of those platforms. So follow me on there. But I said this is the lowest balance sheet since June 2021. The Fed rolled off nearly $1 trillion in assets in 18 months. So obviously, the Fed is no longer buying treasuries at the rate that it was buying. The government, unfortunately, is heading towards a $2 trillion deficit towards the end of this year. This means that the government is spending more than it's taking in. So it will likely have to issue even more treasuries to raise even more money. And everyone is scared that the Fed is going to keep their rates higher for longer. I think they're going to do one more rate hike, and then they will likely pause, and that will be the last rate hike. But it's how long are they going to pause for? Are they going to pause for months? Are they going to pause well into next year? So even if you look at the estimates for up until March 2024, most of the estimates say that the Fed is going to be at these same rates. And also, if you look at the summary of economic projections from the last Fed meeting, most Fed members said that they only favor one rate cut next year, if so, right? So there is a higher for longer narrative that is scaring people. Now, remember that the bond market is just like the stock market. The bond market is a robust market. There are buyers and sellers. And also remember that there are bond ETFs. So just like you invest in a stock or an ETF and you decide to sell it when it tanks, a lot of investors do that too. So it's not just buying treasuries or buying corporate bonds. People invest in bonds through ETFs like AGG, like TLT, the one that I incessantly get asked about. So the sell-off of these bonds also counts towards a bond sell-off, right? Now we're going to watch one more video, and this is JP Morgan's Bob Michel. And this is what I was saying that this is what billionaires are actually terrified about.
How long have you been doing this? A long time, Bob?
Too long.
So you probably got a lot of money after all this. Would you bet the house that we don't see 8%?
So
you're taking a long time.
I am so grateful that the head of our bank isn't drawn into my world of trying to guess the next 50 basis points from the Fed.
Is it completely impossible that in the next 5 years we go significantly higher? Or?
Oh, no, not at all. And I think certainly that was a stress test to the market, and the bank has to be prepared for
When do things break?
When do things break?
Something break.
Well, I think we've just delivered another rate shock to the system. I don't know about central business district, commercial real estate. That hasn't been solved
Could be any day,
yet.
is what you're saying? We're there already? Are we at a point where there is some stress we don't know about under the surface?
Well, we knew 6 months ago that rates at those levels took out the regional banking system, Definitely these rate shocks create some sort of stress.
So the reason that this is a worry much more than the stock market is because the Fed funds rate and interest rates in general affect the economy much more than the stock market, right? You have the yields and then the stock market is below it. Like the yields affect what goes on in the stock market. So I know that you and I are focused more on the stock market, but they are focused more on yields because the yields really anchor everything in our economy. The longer that the Fed keeps rates higher, the more that they sell off assets off of their balance sheet, meaning there's now more supply of treasuries in the market. And if nobody buys those, then yields continue to shoot up. The more that the Treasury has to keep issuing treasuries, because that's a whole other Ponzi scheme, right? In order to make sure that they have money that the government can spend, even though we're spending like crazy. Again, another whole issue. If you start seeing rates at 8, 9, 10, or as Rick Santelli said, 13%, imagine what mortgages are going to be. Imagine the treasuries that banks hold on their balance sheet, just like we saw the regional banks blow up, right? Imagine the government's interest payments on the treasuries that they owe money on. Imagine the economy trying to operate at these high rates. Something will break and they know it. And that's why he kind of gave a tongue-in-cheek answer and couldn't even say whether, rates, whether it's impossible for rates to go up to 8%. Right now, they're hovering just under 5%. And he's talking about long-term rates there. Also, 5% is what we had before the great financial crisis, but we've been operating in a zero rate environment for so long, for 15 years. We've been operating, or 14 years before they started raising rates again. So once we start approaching that 5% psychological level on the long end, if you look at the 10-year right now, it's trading at almost 4.8. Once we start approaching that level, bond investors are going to say, oh my God, we're nearing these levels we haven't seen. It's going to get worse because of all the things I just outlined with the Treasury and the Fed, and the bond sell-off will likely continue. However, I do think that the Fed is actually going to start cutting. I do think that there's a point where where the bond market just gets oversold, where the fear just gets too much, and where we can likely start investing in bonds again. If we look at this, I mean, this is the lowest that TLT's been since 2002. AGG, which I already talked about. This is, if we close here at this level, this will be, actually, we have had the lowest candle closes on the monthly. These are the lowest candle closes on the monthly ever. In 2008, we actually did drop below, but on the monthly, it looks like a spike down, like a capitulation wick. And we have closed routinely before the closes that we saw in 2008. As I said, this is the worst bond sell-off in AGG of all time. However, in my view, for the very long term, I do think that this is a steal, and I will tell you why. I do think that the Fed is going to start cutting by next year. For sure, I think that. I think they'll cut at least once next year. So I do think higher for longer will be the case until we get a recession, and I think we will go back to money printing and low rates. That is just my thought. I don't think we are going to hit that 8, 10, 12, 13%. I think something is going to break before then. And I definitely think that these dividend-paying ETFs like AGG, like TLT, I think there is an opportunity there. I'm not yet going to take advantage of the Fed funds futures trade that I talk about, where when the Fed cuts, I am going to likely have a pretty big size trade on ZT futures, which is the 2-year Treasury futures. I'm not going to be in that. However, not yet, but investing in TLT or AGG for the long term, I think you can start to invest in that. In my view, this is only my opinion, because of the historically low levels, and in general, in any market that I'm interested in investing in, I want to buy the fear. And right now, we are seeing more fear in the bond market, even by billionaires talking about 8% and 13%. We're seeing more fear in the bond market than ever before, at least in our lifetime. And lastly, I'm going to round this off to the S&P 500. But if you want access to all of our trades, all of my investments, all of my analysis, I just put out my weekly analysis for the S&P 500. And I had a monster day trade on today's live stream, today's pre-market live stream, which I go live with the Discord every single week. Our pre-market live stream, I had a short on RTY, which is the Russell 2000 futures. Make sure you click the link in the description. Be a part of our community, our vibrant community with 3 full-time analysts. where we talk about day trades, futures, options, long-term bonds, treasuries, cover call strategies, cash secure put strategies, etc. Our current cash secure put on the SPY is up 45%. I sold the 400 put back when I was telling you that I thought we were going to drop below that head and shoulders. This one here, I ended up selling the 400 put at this consolidation level here. Happy to get a sign on that if I get a sign on that. So if you want to learn how to do that, come be a part of our group. And lastly, I do think that we are at an inflection point here. As I said today, as of the time of this recording, the bond market is closed. So we didn't get a chance to see whether the 10-year is going to keep rallying, and stocks really had a chance to play a little bit. As I said before, I don't think the war in the Middle East is going to have long-term effects on the markets. Wars never have long-term effects on the market unless it is a major war, obviously like World War II. But we are now coming up on resistance. This is an SR flip. It used to be resistance from last August. Then it became support back in June 2023, as well as September 2023, and now it is resistance again, this neckline of the head and shoulders. We do have CPI coming out October 12th, I believe. On Thursday, October 12th, we do have CPI coming out. So, and we also have earnings season that is starting next week as of the time of this recording. In my view, I do think the 10-year is going to 5%, and I think that will cause one last capitulation down on the S&P 500. As I said before, I could be wrong. We already got near to the level I was addressing. I was looking for that 405 to 410 level on the S&P 500. We did get to 420. So I was looking for that level, but if the CPI data comes in good, and I personally don't think earnings are going to be that drastically affected, this potentially could be the bottom for 2023. And as I said before, I do expect a year-end rally, barring a black swan event. And I do think oil eventually gets back up to the 90s, if not $100. Oil is more affected by the geopolitical situation than the stock market is. Anyway, traders, if you got something out of this video, leave it a big fat thumbs up. Leave it in the comment section below. Let me know what you think is going to happen in the market. Did we hit a bottom for 2023 or no? Are you investing in bonds, or is your cash on the sideline? Let me know what you're investing in. I will be bringing back the top stocks video by popular demand. A lot of you guys asked me to do that, so I will be doing that. So watch out for that, and check the link in the description below if you want to sign up for our next mastermind. Anyway, traders, that is it for this video. Hit that thumbs up, subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.